In more company earnings news, Astral has put the impact of the avian flu behind it. During the interim period, the poultry maker benefited from lower fuel costs, less power cuts and a strong showing from its poultry division. And so it's delivered a 4% rise in revenue while headline earnings per share surged to R8.84. This, of course, is from a low base. And joining me now is the company's CEO, Schutte. Thank you so much for your time, Chris. Now, there's a clear recovery from bird flu from the last financial year. Has the actual disease and its financial impact been worked out of the system?
I would like to say that it's worked itself out the system. It's still prevalent amongst the wild birds in South Africa, so there's still a risk to it. We haven't had any reported incidents over the past 4 to 5 months, but it's winter time now and the migratory birds are arriving here from Europe, so it's still a high risk to us, especially in the light that we are not able to vaccinate yet. And of course, in the prior year with the devastating bird flu, there were no compensation for farmers killing their birds in order to control the disease. So a high risk to us, and no, it's by no means a non-risk to us. It's still a high risk.
Well, Chris, let's actually talk about the selling prices, because we did see, a spike in those selling prices last year because of the bird flu. I understand that you were also able to increase your selling prices for poultry in this period. Is that mainly because of the risk that still does persist from bird flu, or is it just a recovery of the cost that you were not able to recover in the previous financial year?
Yeah, I think we made it clear throughout the prior period that we were actually subsidizing the input cost of producing poultry, both the feed perspective of that, a higher feed cost, and also higher feed required because of the big birds on the back of load shedding. And at the same time, we had, of course, the bird flu, the load shedding, and a number of other factors contributing that we subsidized, like the highest maize price in our history. And we were subsidizing it. We obviously tried to recover from that. So chicken prices didn't really spike. It went up slightly. A year-on-year increase for the 6 months of 7%. Most of that was to come out of a loss situation. And if you look at our margins, you will see it's still paper thin. So I think people out there might think that we're profiteering, but at a margin of 2.4%, it's still paper thin, and not where we would like to see it for a volatile business like poultry production.
And actually, why is that, Chris? Is it just that there isn't much room for you to get that cost passed through, maybe because of the demand dynamics right now?
Now, we're very sensitive to the plight of the consumer. And of course, supply and demand in a product like poultry will determine the price at the end of the day. And we never had a shortage of chicken production in South Africa during the bird flu situation. There was a lot spoken and reported on that, but never a bird shortage. So we currently still produce the same number of birds than over the past year or two on the back of imports of fertile eggs. So that's how we mitigated the bird flu. And the country as a whole still slaughtering in the order of 21.5 million birds per week. But the consumer spending is weaker and the unemployment is up. So it is a fine balance to try and hit that sweet spot between a decent margin and not losing volumes in the market. So it's more of a art than a financial instrument. So you need to find the sweet spot, make sure you keep up your volumes and not profiteer.
Chris, you mentioned obviously one of the factors that have overburdened your numbers has been load shedding. And I'm wondering if now you can maybe breathe a sigh of relief, considering that we're seeing lower levels of load shedding?
Yeah, the load shedding impact was massive in the second half of the prior period. And the bigger part of that was additional feed cost and additional shifts because we couldn't process the birds, and then they grow bigger and you need to feed them. We, at the time, also said we're going to pull that back with a number of actions that we deployed in the company, but the diesel cost will remain. Now, we burned in the order of 45 million rand of diesel, additional diesel during the stage 6 load shedding. There's a bit of a relief now. Our load shedding cost or diesel cost for the first 6 months was 100 million. That also could have been in our profit figure and help us to recover our debt situation. But the relief or the no load shedding was actually just outside this period from April onwards. So that could reflect, if it was not an election ploy, it should be seen in our second half figures. But currently, definitely at a lower level, and that improve our cost base.
All right. So improved cost base, and I do understand, obviously, because of the higher cost base that you had before, you were very prudent on your capital expenditure. And I'm wondering now that with this kind of easing, inflation, easing costs on load shedding, on diesel, are you still approaching your capital allocation from a cautious point of view? What are your main priorities right now there?
No, we're still in a debt situation. We recovered well from over R1 billion of debt the first time in our history to a facility of 400 million approximately. So there's been a big improvement, and in a volatile business like poultry production, you don't want debt because it can easily have a negative spin on the business when you get these external factors. But very cautious on capital. So over the next 6 to 12 months, the focus will still be on recovering our balance sheet and strengthening that. And so no major capex over the next 6 to 12 months. It will be critical capex on maintenance. So yes, it is a massive focus point.
All right. Well, thank you so much for your time and giving us more detail on those numbers that came out from Astral earlier on this morning. That was the CEO of Astral, Chris Schutte.